It's magic, you know.
It can be magic. Welcome back, folks, the Ray Lucia Show. There's some magic to this program. Just like the magic when I was talking with my pal Tim Morton, who's the CEO of Westland Financial, about the magic of a MIGA compared to a bank CD. Tim, welcome to the show.
Thanks,
It's been a while, buddy, since we've had you on.
Thanks for having me, yeah.
I guess your boss, Pastula, pulled rank on you or something, huh?
For a few months here, yeah.
Yeah, so we sent him off to Italy, and you're doing the fill-in. That's great.
Perfect, yeah.
Okay, so a MIGA. A lot of people want to know, what in the heck is a MIGA? First, I look up CD rates, and I made a mistake. I said it was 2.7% for a 5-year CD, the highest I could find online. And by the way, you got to go online and buy a $100,000 jumbo CD. I know a few of you will. I wouldn't do it. I wouldn't, A, know how to do it. And number two, I don't want to wire money to some bank in Nigeria. It's just not my style. In either event, CIT, which is obviously a credible bank, it's a 4 out of 5 stars. 2.27% on a jumbo for $100,000. And then I see something from you here, a MIGA would pay 3.05% for 6 years with 15% liquidity, free withdrawals, and you can go all the way down to $25,000. That sounds like a pretty good deal. So first of all, what in the world is a MIGA?
Well, a MIGA is just an abbreviation for a multi-year guarantee annuity. It's a CD-like annuity. So instead of at a bank, you're in an insurance company product, and it'll be a fixed rate for a period of time, either 3, 5, 7, 10 year type period. And that's fixed rate.
So this is like a CD. So you can buy a bank CD, or you can buy a MIGA quote CD from an insurance company, assuming the insurance company stays in business. Obviously, the bank's got the FDIC insurance. A lot of insurance companies have some kind of a guarantee fund too, correct?
Correct, and they're usually protected by the state guarantees.
Yeah, so I think we could make a tiny argument that bank CDs would be a tad bit safer, but this is a pretty safe instrument, right?
Very safe.
Okay, so now the rub on insurance companies is you got to give them your money and you can't get the money out. The bank CD, you give them your money, you can get your money out, but there's a substantial penalty for early withdrawal. Well, there's a substantial penalty for early withdrawal with the insurance company. It might be even a little more substantial. I don't know what the banks charge, 6-month interest or whatever. But the insurance company, it says here, up to 15% free withdrawal. So I put $100,000 in. What does that mean?
It just means if an event that comes up in your life that you need some cash out of that account, you can withdraw up to 15%. Without any penalty on the interest that have already been earned or what you're earning. Like in a bank CD, if you took your money out early, you get that 6-month maybe penalty on the interest that you've earned. But in this, you'd be able to withdraw a portion of your deposit without any penalty.
Okay, so I put $100,000 in. 6 months goes by, I have an emergency. I can get to $15,000, no substantial penalty for early withdrawal.
Correct. And you can actually get all of your money, but the more over that 15%, you would be paying a little penalty on that.
And it might be 3, 5%, whatever the number
Correct.
is. So
Right.
you'd be giving up a lot of your interest at that point. But it's still a pretty reasonable deal. Then the other thing that the MIGA offers that the bank CDs do not offer is tax deferral. So if it really is that portion of your portfolio that's sitting in a safe account, whether it be for emergencies or long-term savings, the bank CD at 2.27%, you have to pay income tax on that. So maybe you net down to about 1.5%. You put the money into the MIGA, you get that money tax deferred, and you pay taxes when the money comes out, correct?
That's correct. And we do a lot of analysis on these two. We call them, we do the cost of waiting analysis. So when you have a bank CD at 2% and maybe an annuity, a fixed annuity, MIGA at 3%, well, how much if you chose the CD versus the annuity? What's the arbitrage there? So I go into the annuity for 3%, and let's say it goes for 2 or 3 years. How much would you have had to put into the CD in order to catch up to what that annuity would have produced? And it's an amazing calculation when you start looking at it. 2% you might need a renewal rate next year of 4 or 5% just to catch up to what you were earning on the annuity portion. And it goes even further than that. So if you go,
here's what else is interesting, and I've done those kind of calculations before. That's neat. I'd like to see that again, because it's been years since I whipped out my HP 12C and have done those calcs. But if interest rates are going to start going up, people would be reluctant to buy a 5-year CD today, because they're going to wait it out. They're going to say, well, I'll wait for the Fed to make their move and then I'll buy. And the problem with that is the money's earning nothing in the interim while you wait. In this example, and by the way, you don't know if the Fed's going to actually raise rates. They keep threatening to. Then you get 0.2% GDP growth and a super strong dollar. And personally speaking, I don't see the Fed making any big moves with 0.2 GDP, all right? That's my personal opinion. However, having said that, if I can get to 15% per year of my money and interest rates do start to go up, the bank CD, I'm locked in because I've got to pay the substantial penalty if I start moving any money out. I can take 15% out the first year and reinvest that money in a CD that latter amount, I guess, that earns more. And then the next year I can take 15% out and 15% out. And that calculation probably looks way better than just a bank CD that's paying 1% less to begin with.
So there's two things here, right, that are really important to know. One is people do sit on the sidelines with their cash. They're either in savings accounts or money market accounts and not even earning that 2% in the CD, because they're in a less than maybe a 0.1 or 0.2% in a money market account. So that's where the big cost of waiting. If I'm waiting for a CD rate to be able to put that fixed money in, now in versus having a 3% annuity, now that cost of waiting becomes very, very big. And what would the CD have to be to make up to that 3% over, let's say you lost a year of 3%, what would the CD have to be?
Yeah, that's a
It'd have
good
to be like 5%. And are CD rates going to be that much bigger today or a year from now than they are today?
Yeah, I don't think they will be. And as I said, even if they are, if I can take 15% of my money out, I can go buy a CD at the higher rates a year from now.
And we never would allocate all of somebody's money into a product like that anyway, that even has a liquidity amount, because we don't want anybody to have to tap into it. If you're going to put money into a long-term investment, let's do that. But let's say CDs did spike up. We had this inflationary type of period and rates went to 2 and 5 and 7% on the CDs over the next 5 years. What would happen? Well, in an old CD that you were in, you'd have to liquidate your CD to get the new CD rates. And here you could maybe at the very first tranche, you could take the 15% and continue to take 15% each year until you exhaust your balance.
Tim Morton, my special guest, SafeMoneyMonitor.com. Check these dudes out because they quote all kinds of different annuity contracts. Now we're going to take a break. When we come back, I'm going to ask Tim why the pushback from individuals, pundits, journalists on this MIGA stuff or annuities. Why are they so anti-annuity? I also want to ask him about long-term health care and how you might be able to take that annuity contract and turn it into a double, right? Hit a nice double. What do I mean by that? You got to stick around and find out. It's like the Doublemint twins, only better. They got to be 70 years old. What are you chuckling about, for crying out loud? Don't go away, folks. 844-RAY-SHOW is the number. 844-729-7469.
Double fresh.
And welcome back, folks. The Ray Lucia Show. Okay, I made a mistake. They're not 70 years old. I think that commercial ran in 1987. What were they, like 20 years old then? So, okay, they're not 70, but welcome back. Tim Morton, my special guest. We're talking about MIGAs here, multi-year guaranteed annuity contracts. Why would you buy a CD? Why would you buy a CD at 2% when you can buy a MIGA at 3%, get tax deferral, have no substantial penalty for early withdrawal on the first 15% that you take out on an annualized basis, and have similar security, not quite as good because you don't have the FDIC behind you, but you have a big insurance company, A-rated, whatever it may be, and a state guarantee fund. especially if you're under the state guarantee fund limits, which, Tim, are up 100,000 in most.
100,000 for annuities, maybe 250 in a lot of states.
Yeah. So Tim Morton from Westland Financial and the Safe Money Monitor joining me. Now, there's one other benefit that I've been doing a tiny bit of research on, and that has to do with how you might be able to have a long-term care rider, because not everybody can qualify for long-term care insurance. It's one of the big frustrations that I've seen, and I've talked to a lot of people about this, is many of us procrastinate buying long-term health care insurance until such time that we may not be able to qualify. Now, I don't know if this is a free ride for you, but can you talk about the Doublemint Twins annuity plan, we'll call it?
Sure. Well, first thing I want to say is that, long-term care insurance or long-term care planning is something that really needs to be looked at more so than ever. It's very important. I mean, when you get sick, the first thing you're going to do is not look at what rate of return I got on my portfolio. You're going to really think about my insurance products, my health insurance, and those kinds of things.
It's true.
So to get started on that early is better while you're healthy and can qualify, because it is an exclusive club. You've got to be healthy enough to qualify. And there are different qualifying requirements other than health insurance, because these are things that are debilitating types of qualifications. So if you have Parkinson's and those kinds of things, you may not qualify for for the long-term care, but you might be able to still qualify for a life insurance product, that kind of a idea. So get started early if you are going to do that. But we work with clients all across the country. And the annuity side, the annuity space is for a lot of times when folks cannot qualify for long-term care or the life insurance with the long-term care options, which we really promote a lot of. It's what do we do next? And it's really just setting money aside into an annuity product, maybe one that has an income rider on it. It's an indexed annuity that has an income rider. The income rider gives you a guaranteed stream of income whenever you turn that income stream on for the rest of your life.
So I have $100,000.
Right.
The income rider might give me $5,000 for the rest of my life, perhaps a joint life, $5,000, $4,500, something like that, forever and ever and ever, amen.
Correct. Even if the annuity value went to zero, the insurance companies are still obligated to continue to pay the income for as long as you live.
Which answers the question why these guys go on the radio and television and say, my clients never lost money because there's no way to lose, only a way to win, and then they can always flip that annuity into a guaranteed payment for life.
Correct. And then when we talk about the long-term care rider, if you're chronically ill or terminally ill, what happens if you're already taking income? What the insurance companies have done is put a rider on there that says if you need that income, or if you go into a convalescent care type of facility or long-term care need, then the income will double. So let's say you were getting that $5,000 a year. It's only not very much as far as monthly income, but it's still something. Any income extra when you need care is a big add-on to your options that are available to your family. So if that income can double for a period of maybe 5 years, then that at least gives you some extra income. And then let's say you pass away and it was a spousal type of a situation, the income would go back down to the original level and still be continued for the rest of your life.
Okay, so there's got to be a cost to this. So what am I paying for this benefit of doubling my income in the event that I need long-term health care?
Well, there's no added cost for the long-term care rider. You're paying a cost for the actual income rider, typically on these products. So maybe it's a 1% cost on the index annuity. So let's say an index product is you put that 100,000 in and you're buying the index and the rider for the income, then maybe it's a 1% charge on that. So if you earn 3%, you had a 1% charge, you might only net 2%, but you're not looking at it that way. You're looking at it for the guarantees. The guarantees, yes, it's a low yielding type of product. It's a safe product.
Yeah, but when you compare that to spending $5,000 a year or $10,000 a year for two people anyway for a long-term care policy, I mean, it's not to replace a long-term care policy, but there are individuals, I know of one for certain that I met recently, whose spouse just can't qualify for it. Mm-hmm. So that to me sounds like a reasonable thing for individuals to consider. So let me just, I got to get this straight in my own mind, because I've got a background in this business, as you know, but I've never sold one of these as an insurance guy years ago, and these are fairly new. So if I put the money into, say, an index annuity contract that pays me a spread, the market goes up 10, the spread's 3, I make 7, right? You're saying that 7 would turn into 6 or 5.5 or something like that, and I could add this annuity rider that doubled the income for, say, the first 5 years for long-term care. Is that about right?
It's about right, yes. That's exactly right. So your income...
Wait a minute, is it about right or is it exactly right?
Well, again, a lot of products have all kinds of different stories and different criteria to qualify. And that's why you want to work with an expert, somebody that really knows what they're doing. But there's a lot of options there. And what are the triggers in order to get the benefits out of the product? Is it 90 days of consecutive, long-term care in a nursing home? Is it service days versus calendar days? Those kinds of things. There's a lot of different little nuances that are included in these products, and you got to know what you're doing. But just to understand what your benefit is. What are you paying for, and what are you getting? And really, when you're talking about an income stream, whatever that income stream is, it'll double for a period of time when you are in a convalescent facility over maybe the 90-day. After that initial 90-day period is up.
And the cost is somewhere in the vicinity of 1% of your earnings.
But the 1% isn't for the long-term care rider. The 1% is just for the income rider that's on the annuity itself.
Well, hang on a second. You don't pay extra for that? I understand that you have to pay something for the income rider, but everybody pays that.
Correct.
Do you get this long-term care rider free? It just tags along for free, or is there an added cost?
It's part of the income rider. So it's not an added cost. It's already factored into that cost for the income rider.
So if you didn't want the long-term care, would you get a better income?
No, it's a bundled. It's a bundled income rider.
So there is no added cost. So if you like the annuity vanilla, just the way it is, you're getting that doubling up of the long-term care benefit basically for free, but there's a cost for the rider.
Correct.
Can't say it. I get that, but you know what I'm saying.
And again, all products are different. There may be a product out there, actually there is one that you'll pay a little bit extra for that. Remember we just talked about the 90-day elimination period. Maybe there's a product that says it's a 180-day elimination period, but pay a little bit more and you get that at a 90-day elimination period, that kind of thing. But maybe that 1% now is 1.05.
You want to learn about this and other products, CD alternatives, go to safemoneymonitor.com. It's pretty simple. They only deal in safe money at Safe Money Monitor and Westland Financial because that's what they call themselves, the Safe Money Monitor. They don't deal with variable stuff that could go down. You guys don't like investments that go down, do you?
No, we're on the conservative side, the safety side. That's definitely our bailiwick.
I've only got a minute. So talk to me about why there's such an apprehension amongst individuals to do any business with an insurance company, but they'll do business with banks all day long.
Well, there's, insurance companies I think are perfectly safe. Most, especially the A-rated and above carriers. There's really should be no hesitancy to do business with those. I think what you're seeing is the financial planning industry, and they're taking a lot of the market share away from the investment side of the house. So of course there's some pushback from the CFPs and the financial planning community because they're taking big chunks of your portfolio to do something safe with. So that's where the pushback comes from. Not really because there's anything inherently bad about any of those products. They're very good products. Tim
Morton, a very, very smart guy. In fact, don't tell Pastul I said this, but Tim's way smarter than him. He's just the big boss. That's all I'm saying. No, Gene's he's a super guy, and we wish him well over in Sicily, Italy. Have a bunch of pasta and a glass of wine for me. We went out to dinner last week at his and my favorite Italian restaurant. How come he didn't invite you? What's up with that? You're half Italian.
That's because I was in South Africa.
Oh, that's right. Oh, you guys make way too much money. All right, we'll take a break, come back. I'll give you my thoughts, some emails. Tim, nice job, brother. Good to see you again, man.
Nice to see you again, Ray.
I do some work with his son, as a matter of fact, who's way smarter than his dad. Just kidding.
Much better looking.
He's a really handsome young. Both of your boys. You have 2 boys?
3 boys. 3 sons.
How come I haven't met the other one?
And they're good looking because I'm 50% Italian like you.
Exactly. And you have a beautiful wife. Why don't you say that?